Welcome everyone to NAAIM Confidential. This week we have John Llodra from New Harbor Financial in Massachusetts. My name is Asher Rogovy. I'll be your host today. Well, first, thanks for joining us. How are you doing?
Very well, thank you, Asher. Really a pleasure to be here, and as a newer member of NAAIM, I'm really excited to jump in the ring here and hopefully give a little bit. But I've learned so much from fellow NAAIM members, and I look forward to continuing to do so.
Well, fantastic. Speaking of other NAAIM members, let's start right off and look at the NAAIM Exposure Index, a weekly survey of our members to see how exposed they are to equities. Pull that up here. So not much of a change from last week. This week came in at 85.26. Previous week was 86.3. Small little tick down, but still towards the high of the range. And the market's been strong. John, what do you see in this index?
Well, I see that my firm is a bit contrarian, I suppose, because our effective equity exposure right now is closer to 40%. We do have some hedges that we use, options and hedging tools, but we actually hold quite a sizable chunk of short-term treasuries right now. Not as a kind of put your head in the sand kind of measure, but we think a lot of indicators and certainly valuations and such are very extreme right now. And we, and frankly, everybody and their mother has noticed a degradation, a rather concerning degradation of the breadth of this market on many different metrics. None of this, of course, is precise in timing, but it's we ascribe to a weight of the evidence type of approach that I know many NAAIM members do. But for all the reasons we see, we're quite a bit less invested than the average NAAIM advisor.
Great. Well, yeah, I agree. I feel like this is a bit of a nervous index right now, and valuations certainly are stretched. It would be interesting to watch the next few weeks of this to see if there's any collapse. Let's start. Let's talk about valuations. So, a number of things I look at are kind of the overvalued territory from the Shiller Cape and Buffett indicator. What are you seeing?
Yeah, well, we obviously can look at any number of valuation metrics. Wall Street's favorite is forward PEs, which we're not big fans of, not least of because of analyst estimates are notoriously sloppy and noisy, and maybe even rosy colored glasses, and they don't have a very good historical correlation with subsequent returns, which is really what matters for our clients. My firm serves individuals and households. We are the client's advisor. We do the investment management, but we're the frontline financial planning and advisory firm for our clients. So we obviously can make use of third-party analysis, and we do very, very often. One of my favorite analysts out there in terms of valuation work is John Hussman. Many folks might be familiar with John Hussman. Brilliant guy. He's got a work ethic that I think is second to none. He puts out some great research. It's generously made available on his website every month for free. He's very humble in offering that up. And I can share a couple of charts there just to kind of give you a flavor, because he's done a very comprehensive review of a lot of different valuation metrics, the Cape, the Buffett indicator and whatnot. And those have varying degrees of reliability or correlation from a historical standpoint anyways with subsequent returns. And I'll share my screen here just to kind of highlight a metric that he's devised that is statistically more robust than any of those. So hopefully you can see my screen here, but this is from a recent market comment of his. This one happens to be from the March commentary. He puts these out every month. I went to this one just because of the charts in this one, but this is the Hussman indicator. It's basically a metric of non-financial market capitalization over non-financial corporate gross value added. Now we can go into a dissertation about what gross value added is. It's an accounting construct, but this is essentially a price to revenue type of ratio. And importantly, it includes, the implication of foreign revenues. Much of the criticism of things like the CAPE ratio are that over the years, more and more of U.S. companies' revenues are derived from overseas sales. This accounts for that. But basically, through some interpolation, he's got this metric that goes back to 1928, essentially. And this has about a historical correlation with subsequent returns over the next 12 years. You might ask why 12 years? 12 years is where the autocorrelation, not to get too wonky here, but the autocorrelation of this and the metric it's trying to measure goes to zero, which basically makes it a very noise-free indicator in that regard. But here we are, and it's actually even worse now, but even as of March, we are at levels that have only been approached in 1928, right before the Great Depression, and at the end of 21, before the somewhat of a swoon in 22. We're well above on this metric, even where we were at the peak of the tech bubble. And just not to beat this to death, but this is a scatter plot of that indicator with actual subsequent 12-year nominal annual returns in the S&P. And for anybody that's conversant with scatter plots, this is about as tightly clustered a scatter plot as you will see in any kind of realm, whether it's medicine or plain old statistics. And this just speaks to the historically tight relationship of this indicator and subsequent returns. Taken at face value, this suggests the total nominal annual return in the S&P is on track to be something like -4% over the next 12 years. Seems absurd, but when you get to absurd valuations, at least history would say that's a number that is founded in reasonable expectation. Now, John Hussman would be the first one to say this is not a forecast. Certainly it requires a certain amount of reversion to the mean and that kind of thing, which, there's all kinds of distortions in markets. But no matter how you slice it, valuations we think are extraordinarily high, and simple rule of thumb, subsequent returns are very much dictated, at least over longer horizons, by starting valuations.
Wow. So that is certainly a tight correlation. I'm a bit of a stats wonk myself. Is there an R squared on that one?
I don't know what the R square is, but it's about 93% correlation, and I'm sure John, if he were on the phone here, would rattle that out right now. But he's about as thorough from a quantitative standpoint as I've seen folks be.
That's impressive, 93%. So he's forecasting low equity returns on average over the next 12 years.
Yep, that's the bottom line takeaway. Low and quite disappointing, actually.
So what's your approach to addressing that market condition?
Yeah, so we kind of use valuations. We're the first to admit, and John Hussman would admit, that valuations are horrible short-term timing indicators. They have almost no meaning in the short term. So we do use technical factors. We don't have any, I will admit I'm a engineer by training. I studied operations research at Cornell, so I have a mathematical leaning, and if left to my own devices, I'd love to be in a cave, trying to design better mousetraps, right? There are some fabulous work by NAAIM members in exactly this kind of research, and I feel frankly a little bit humbled and inadequate in the company of some of the folks and the great work they do. Got so much to do with our clients that we'll be the first to humbly admit that we don't have all the answers, and we're students of the market and constantly learning. But what we make use of a lot of different technical indicators. We've been longtime subscribers to a data service called Dorsey, Wright and Associates. Broad dashboard of technical indicators. At the very heart of that discipline are things like relative strength that we use, for example, to guide sector rotation movements. We look at breadth indicators, things like bullish percents, kind of breadth indicators like, percentage of stocks above certain moving averages, and advanced decline lines, high-low indicators, all of which are starting to present a pretty troubling picture in terms of market breadth. The way we use valuations is to kind of set the backdrop of look, I kind of like to use the analogy of, if our job is to get clients safely from one end of the balance beam to the other end during their retirement period, it's a different proposition if that balance beam is sitting on the ground versus 50 stories up. In other words, the cost of a misstep can be far greater. And I liken valuations as, kind of a barometer of how high off the ground is that balance beam. So we're inclined to put much less faith in our technical indicators when we get extreme valuations like we have now than we would be, for example, in a much more kinder valuation environment. For pure technicians, that's blasphemy. I know that, but at the end of the day, we're trying to create a ride that will, first and foremost, get our clients through their lifetimes, hopefully with secure financial situation, but also smooth out the ride along the way. Volatility and mitigating that is one of our key objectives. So, as I mentioned in the outset, we're about 40% equities right now. Even before this recent technical degradation in breadth and things like that, things were very strong from a technical standpoint. In a pure technical sense, we could have made the case to be 100% in stocks, maybe even leverage long in stocks over 100%. But our concerns about valuations and some of the backdrop, strongly neutered that signal in our kind of discipline, for better or for worse.
Yeah, for sure. I love that analogy of the balance beam. Client leverage also seems to raise the balance beam as well.
I mean, we adopt a pretty simple motto. Best way to make money is to first not lose it or lose a lot of it, because ultimately psychology is one of the biggest. You can have the most rigorous process, the most statistically sound back testing or whatever you want to look at, and if the psychology of the advisor, we're humans as well. We have to better our own psychology, but if the psychology of the client is not such to be able to stay on the ride, that matters. It's not an academic exercise to know that you got to create the ride that clients can stay on.
Absolutely. So, if low or average returns are predicted over the next 12 years, how do you play that? Do you buy some dips? Are you, if we rally into a euphoric zone, would you cut equities even lower?
In a word, yes. So just take, for example, 2022, for example, we had a pretty challenging year in the stock market. We were very lightly exposed to stocks, but there were 3 or 4, we thought, very viable points in that year, even though valuations wouldn't have approached what we would consider to be, really compelling valuations. But, the combination of oversoldness, horrible sentiment, washed out conditions on some of the breadth indicators that I just spoke of, that gave us, more fortitude to be more invested in stocks than valuations alone would justify. So absolutely, one of the reasons we're holding a big chunk of short-term treasuries is because of the safety, but the optionality that provides. In an instant, that capital can be quickly deployed into other things, be it stock or bonds or whatever the case might be, commodities. We're kind of agnostic when it comes to that. We let the data kind of guide us as to where the relative strength is. But absolutely, we think there's plenty of, and maybe a look back in history. If you look at the 70s, for example, which was a inflationary environment, you might say has some rhyming with the environment we're in today. On a real basis, stocks lost money during the 70s, but there were some tremendous bottoms to be bought in the 70s, and simply being a bit more tactical could have turned what otherwise was a very disappointing buy and hold environment into a very productive real return type of environment. But the key is in the timing, and market timing has become a 4-letter word in our industry. We think it's absolutely imperative, not in the sense of timing to precision, but in timing in tactical adjustments with valuations in mind, with technicals in mind. And it's funny. I queued up a paper here just to kind of put a point on that. And if I could just share my screen here, this is a paper that was put out this past October by none other than Vanguard. And Vanguard, many folks might perceive to be, and in fact they are, probably the biggest champion of just buy and hold, set it and forget it investing. But even Vanguard put out a research paper talking about when valuations get extreme, that kind of approach may actually be downright damaging, if not disappointing, to investors. And they go through a big paper here, and basically it's their most genteel way of saying that we think there's merit in tactical adjustments to the otherwise set it and forget it portfolio that can be very sensible for folks in kind of achieving their retirement planning needs.
Absolutely. It occurs to me, this might just be common sense, but active investing is the only way to avoid a massive market drawdown. If a passive philosophy is going to eat, potentially a 20% loss someday, whereas an active manager is aiming to avoid that. And if you want to avoid a 20% drawdown, active is your only choice, right?
I couldn't agree more. It's obviously academically, easy to talk about. It's very hard to do in practice. That's why we rely on our data, our dashboards, and it's without data, you kind of are left to your own devices, your own kind of emotions, and that can be a very dangerous thing, even for investment professionals sitting in the seat we sit in.
Definitely. I really like your approach to combine fundamental and technical data together. I think that's a very powerful combination. And a lot of people tend to focus on one or the other. Do you take a rules-based approach, or is it like a soft rules guardrails, or is it entirely discretionary?
Yeah, I would love to say we have a hard rules-based approach, but we don't. We have what I think your description there is very apt, a soft guardrails type approach. Ultimately, we have an investment committee. I and my founding partner chair that committee, and we get in a room, we battle it out. Basically, we test each other's kind of views on things and interpretations of things, and there is some merit, I think, in having rule by committee in some of these decisions. Certainly,
and you avoid the problem of overfitting with softer guardrails.
Exactly right. Yeah, I mean, it's one of the, and in our system, as much as it is a system, is every bit as prone to whiplashing and whipsaws that the market of these last many years, I think, have been dramatically distorted with the monetary policies that have been unleashed over the last decade, and we're just starting to kind of try to normalize. I don't think it has totally negated market signals, but it certainly has distorted them in ways that I think we'll only see in hindsight. Yeah.
Cool. Anything else you want to mention about your firm or your approach?
Well, no, I mean, we're like I said, we're happy to be amongst peers that can be a lonely place in a financial world that has shamed investors into thinking that they're doing themselves great harm if they're not fully investing their assets all the time. The financial industry is a very powerful messaging tool, and I'm glad that we can find peers that see a different way, not because markets aren't good places to be, but there's times where healthy skepticism and restraint are absolutely important, especially when you think about what ultimately all of us are, whether you're on the front line with some clients like my firm is, or serving other financial advisors as an outside manager. Ultimately, this is not about putting wins in a scorecard in the newspaper. It's about real people being able to live secure and hopefully stress-free lives as relates to their financial savings. That is a real heavy task that we take with great honor and obligation. And sometimes we have to be somewhat spoilers at the party when things are getting a little bit too frivolous, and we think we're kind of in one of those phases right now. So not an easy job, and I like to say, the world we in, the investment world that we're in, there is an infinite number of opportunities for regret, and that regret can come in so many different forms. Lightening up or selling too early, selling too late, or any variations of that. And so I think it's really important to come to peace with regret. Regret can be a healthy thing. You need not get every last squeeze of juice out of a market run to still end up doing very well. And, mitigating volatility is a big part of it, especially for folks that are trying to create a paycheck, a recurring paycheck from their retirement savings after they've retired.
Definitely. Any to close, do you have any famous investing or financial quotes from Wall Street legends or other sources of wisdom?
Oh boy, there's so many. Maybe I'll turn to one that's a little bit corny, but I think I'm feeling particularly philosophical here on a late Friday afternoon, and reminding myself that life is a pretty good thing, especially if you have people around you that you care about and care about you. And there was a quote, and I honestly can't remember who it was, but it stuck with me. The quote was basically to the effect of this: your most valuable asset is time and not money. And a rich life is about spending that time well. Again, kind of corny and philosophical, but I think it really, so many people get distressed, stressed, enamored, seduced by this thing we call money. And it's really important to have a healthy balance as relates to that and how it fits into our lives.
Absolutely. Well, John, thanks for joining us today. As a final send off, where can people find out more about you and your firm? Any social medias you want to plug?
Yeah, sure. My firm is New Harbor Financial Group. The website is newharborfinancial.com. We actually have a Twitter and a YouTube page. We have appeared for the last decade or so on an influencer website. A company called Thoughtful Money. A good friend of ours, Adam Taggart, founded that. He's got 100,000 YouTube followers. We're an endorsed advisor by the folks at Thoughtful Money. But through that, we had a certain level of accidental celebrity, and we started our own YouTube channel. So on YouTube, you just search for New Harbor Financial Group. I think it's New Harbor Fin, Fin is the short name. And then same on Twitter. But we try to share timely and kind of appropriate takes on different things, whether it's markets related, financial planning related, and we're just trying to educate in the way that we can and leverage those platforms to do so as widely as we can.
Great. Well, thanks for joining us. Tune in next week for another episode of NAAIM Confidential.
Thank you very much, Asher. And until then, next time.